Hi, this is George Dagnino again. I'm the editor of the PRUDENT portfolio since 1977. And this series of presentations uh, I use to show you the way I protect my portfolio from devastating events. I have to think different. I reached the point where I cannot trust anyone because they have proven to me that everything they do, everything they say, really does not have any bearing on a serious investment strategy. So, what do I do? This is the first part in the next three presentations, part 4, 5, and 6, to show you my strategy, my tactics, how I implement a strategy to hedge, to protect my portfolio. Again, I'd like to remind you that my objective is not to reach high returns, but instead is managing risk. That is, managing the probability of losing a lot of money. And I do that by reducing the portfolio volatility. By reducing the portfolio volatility, I make my return more predictable, and I have more time to correct the action of my portfolio if I make mistakes or when I make mistakes. The first step, and this is the objective, the basic concept driving the asset selection is that these assets have to have low volatility. And in order to create a low volatility portfolio, again, as I said before, is because in this way the portfolio is easy to modify and to protect if there is an unexpected devastating event. How do you then select asset classes? I wrote a book about it. Is Profiting in Bull or Bear Markets. I'm not going to go into the details of the business cycle. I'm going to spare you with that. But what is important is if this represents the way the economy is growing, okay, and it goes from very slow growth, improves, and then grows strong above potential, that is above 2.5–3%, then slows down, and then the cycle starts all over again. What is important to understand, if you're operating, you're investing in a period like 2 and 3, or if you're investing in a period like 4 and 1. So this is, are you investing in an environment with strong economic growth, or are you investing in an environment with slow economic growth? You just have to answer those two questions. Now, in the next slides, I'm going to show you how to do it. What are then the asset classes in the two periods when the economy is weak and when the economy is strong? What I found that is in a weak economy, the low volatility asset classes are these ones. Emphasizes in yellow. There are also the other ones, but mainly is staples, real estate, REITs, bonds, financials, utilities, small banks, healthcare. In a strong economy, instead, you want to be more commodity, what I say is commodity sensitive kind of stocks, like metals, basic material, energy, industrials, of course, gold and also technology. But the bottom line is these are the stocks and the sectors that will show much lower volatility in a weak economy. And this, in a weak economy, these sectors here will perform poorly with high volatility and vice versa. So right now, as this recording is made, we are in a very weak economy environment. So let's see what happens. I'm going to show you the various graphs and see what happens to these asset classes in the next slides. The first important step, however, is in order to understand which asset classes you should be in, is understanding what kind of economic growth is you are facing is this should not be as complicated as some people make you believe. It is very, very simple. I'm going to show you two charts now to give you an idea. That's the one I use in my analysis and work. The first graph that I use is the new orders for non-defensive capital goods, excluding aircraft. This is something that you can find in FRED, which is the Federal Reserve Bank of St. Louis. You don't even have to collect the data. But notice how this orders, the growth in this orders is very cyclical. Okay, and obviously here at this point and at this point, the economy has reached the maximum growth. And when you see this inflection point going down and growth slowing down, you know that the economy, doesn't matter whoever says what, the economy here peaked in 2011. Keep this date in mind. Again, 2011, the economy started slowing down well into 2013, according to the growth in orders. Another chart that I use is sales growth, and again is the red line, retail sales growth. The weakens declines actually during a recession, accelerates, and then here slows down and confirms the slowdown in orders. Usually the slowdown in durable goods orders precedes retail sales, so it gives you sort of a sequence of events. And these two lines, the green line and the blue line, is the growth in employment in manufacturing. The growth in manufacturing is probably the more volatile than the total growth, and so it gives you an idea that things are not strengthening. You know, obviously when you see the previous slides in this one, you know, we are not in times like this. Definitely not. Beginning in 2011, we have been in times like this one or like this one. So now we are in an environment where the economy is slowing down. It doesn't take a genius to figure that out. Well, let's see now how the markets have reacted to the effect that is slower growth in the economy. This is the graph of the commodity index. And notice again, the weakness of the economy is now, look at what happens to commodities. Beginning in 2000, actually this beginning in 2011, but the trend in 2012 and 2013 reflects the slower growth of the economy. Again, gold, like all commodities, is also weak. The economy is weak, and gold is coming down. Gold actually peaked in 2011, but see, as the economy started deteriorating further and further, gold, like all metals and all commodities, also weakened. I suggest that you do not consider gold as a special metal. It is not. It behaves, as a lot of volatility, but behaves like most other commodities. This is the chart of crude oil, and crude oil, like all others, see that all these graphs look the same, don't they? Because all commodities behave exactly in the same way. It cannot be that one commodity goes up and everything else goes down. It just does not happen that way. So this is crude oil, same thing. They peaked in 2011, and it just kept on going and going and going. And again, beginning of 2012. A new slide, like gold, like copper and everything else. So commodities go down, and not only that, but notice how volatile they are, because the economy is slowing down, people are nervous, and they think there's going to be a good rally, people are being sucked in, and then they take a bath again. So anyway, the point here is another commodity peaked in 2011 and kept on being weak. Copper is also an important, is an important commodity. And again, it peaked in 2011 when the economy started weakening. So the weaker, and then it started declining like everything else, like gold, like crude oil, like everything. So I watch very closely copper because it's a very, very important commodity. When manufacturing slows down, when manufacturing has decided to cut inventories, and I follow this in great detail in my service, then you can rest assured that copper is going to come down. But when copper comes down, means the economy is weakening, confirms that the economy is weakening, and therefore you should not be in this kind of asset classes. What is the point of part 4? The point of part 4 is you have to decide, what is the business cycle telling you? If the economy is strong, you are in certain asset classes. But if the economy is weak, you should not be in commodities. If the commodities decline, they tell you the economy is weakening. So you should avoid any asset class that is commodity sensitive. And this is what we're going to further investigate in part 5 of this series of presentations. Okay, thank you very much for following this presentation, part 4, and where we show that commodities are not a good investment when the economy is weak, but when the economy is weak, there are certain asset classes that perform well. I'm going to now apply these ideas, business cycle, asset classes, and volatility to specific sectors in part 5 of this series of presentations. Again, thank you very much for following what I'm saying. Thank you.